Good morning, this is Mayor Valensky with Driving Markets. Okay, so I just want to talk a little bit about driving markets. I've had a few comments back, so I just want to go over that. The idea of driving markets was just one day I was driving in the car and I thought I'd give a running commentary on what's happened and what's going to happen in the markets. And while I'm driving, I thought, you know what, I'll call it Driving Markets. Some people have come back with some feedback, some clients and some viewers, and said, why don't I do it in a studio and be more professional with better lighting? Well, that would defeat the whole process, because the whole purpose is to give a market commentary while driving, and therefore give it the title Driving Markets, which is a play on the words. Okay, so that's the idea. So all those people who are new listeners, welcome to Driving Markets. Again, the idea is to give a 4, 5, 6 minute review of where markets are at, a little bit of education and some thoughts going forward and opinions only of where likely markets are likely to go, in my opinion. So that's the idea behind Driving Markets. I do hope you're enjoying it, because I do like giving a report on a daily basis. There have been a couple of new subscribers recently, but not enough. So I would like some more subscribers, would like you to share it, and I would obviously very favorably look at you liking the videos, because that just helps overall reputation and overall rating of the actual YouTube. Okay, so let's go over a couple of points. Yesterday, I apologize. I did a video on another smartphone and it just didn't work out. I don't know what happened. It cut it short from 6 minutes to 1 minute, 1.5 minutes. So I apologize for that. I just want to review on that. I'll review yesterday's video now and then go into where we're going with regarding the markets itself, and tell you what is driving markets today. Okay, so there's a few major bond issues coming into the market. Italy's issuing a 30 billion euro bond, which I mentioned yesterday. I don't know if you caught on to it, and that has to be priced at a certain level in order to make it attractive for investors to invest in that bond. You've also got other European countries that are issuing bonds, as well as the States, Australia and New Zealand. All these bonds are being issued in order to finance the running of the country. The problem is that with interest rates rising, or look like they're going to rise, if they don't get the bond price right, with the yield, in other words, what interest rate they're going to be paying right, then that bond will not be bought. They'll have difficulty selling it. So that is a major point that maybe not everyone is looking at, but it's something that needs to be aware of. As regards US Treasuries, which is the global benchmark of where bonds are at. So in the US, they call the bond the US Treasury note. Yesterday, the 10-year Treasury note hit a yield, the highest in over 2.5 years, of 1.83%, which sent shivers down the financial markets, simply because as yields rise, that is, the rate of return on your money increases, it becomes more attractive to invest in those assets and those investments than it is to invest in speculative investments like stock shares, high-tech shares, NASDAQ, etc. So your people naturally will want to go for where is the guaranteed return, as opposed to where is the speculative return. And the speculative return has been the leader over the last 10-12 years due to cheap money. If that money now becomes more expensive by way of borrowing, by way of borrowing, then people will pull out of the speculative market and put money where it's absolutely more secure, which will be in a bank account or fixed income securities. Fixed income is where it gives you a regular income, either every month or twice a year or once a year, depending on the type of asset you're investing in. Let's look at yesterday. Well, as I've said all along, the fear of inflation and the fear of rising interest rates is impacting on the market. I've said this over and over again, and it's significant. And the markets yesterday took a tumble across the world. From the US to Europe, the markets took a tumble. The NASDAQ was down yesterday over 1.7%. The Dow was down well over 1.5%. The DAX was down 1.5%, simply because people are worried about inflation and they're worried about interest rates. So there was a comment by one of the traders that said, But inflation is good for stock markets. Yes, it is good for stock markets because it shows rising prices and therefore rising revenue. However, interest rates is not good for the stock market. And last year, when they said there would be likely 3 interest rate rises throughout 2022, very, very quickly the analysts were all paid in excess of $500,000 or £500,000 a year, making huge money, quickly rewrote their individual assessments of where inflation is at, and they said, oh, there'll be at least 4 interest rate rises, maybe 5, and that's exactly what I said already back in October, November, looking at 4 to 5 interest rate rises, not 3. I don't believe 3 interest rate rises will solve the problem of inflation. I think inflation is going to go to the area of around 10%. You've got huge underlying pressures on pushing inflation up, and therefore I think interest rates are going to significantly jump in 2022 and for sure in 2023. So just be prepared for that. I'm giving you an advanced opinion or advanced warning opinion, as that's what I think the markets are going at. If, on the other hand, inflation does come under significant control, interest rates are only increased by a small amount, then the markets will absorb that, they'll like it, and you'll end up having a big jump in financial markets. So what is driving markets today? Well, today and this week you've got UK inflation. You've also got more banks reporting. By the way, Goldman Sachs reported yesterday very disappointing figures, and it dropped at one stage over 8%. So just be aware of that if the numbers are disappointing in the reporting season, then those shares will be hammered. So you've got more banks reporting, you've got building in the States, you've got UK inflation reporting this week. So you've got a raft of reports coming out. When you trade, remember, as one client asked me yesterday, he said he always got it right, but he never got enough money on the account. Always make sure you've got enough money on the account. You trade small, and therefore you can ride out any particular storm or any particular hiccup in the financial markets. I'm going to wrap it up there, simply because we've gone well over 7 minutes. I don't want to bore you to tears. You can contact me on LinkedIn, on WhatsApp, Instagram. You can subscribe on YouTube at Meir Walensky. You can like the videos. You can text me if you want. Remember, only trade with good, solid, regulated firms, or firms that are solid, that are going to provide you with the necessary platform to execute your trade. If you need any assistance, please contact me. This is Meir Walensky with Driving Markets. Have a good day.